background.
Sure. I recently joined Pivot as an executive in residence to help with several initiatives. One is pitch prep, so helping technologies and companies perform their pitches better, as well as helping to connect them with venture capitalists and other sources of funding. By background, I've been an entrepreneur in the life science space for over a decade. I've been in senior management, I've been CEO of companies, and then I was also a venture capitalist for about 13 years and invested in life science capital.
Excellent. Thank you, Lisa. And if anybody doesn't understand some of the vernacular, it can be, specific. So venture capitalists, or things like that. If somebody doesn't understand, put it in the chat and we'll go back and explain it. So Beth, go ahead.
I will ask the stupid questions.
But usually my job. You're helping me out. Go ahead, Beth.
So I was an entrepreneur in residence with the U, and then I took one of the spin-outs, Magelco Medical, and became the CEO of that. I recently left that role, and so now I think my role with the U is a little up in the air, and we haven't really discussed it a whole lot, but we will.
Absolutely.
So my background is a very technical background. I started out in environmental consulting at an environmental consulting firm as a chemist, and it was a startup environmental engineering organization. So that's how I cut my teeth on startups.
Excellent. And Beth didn't say the technology that Beth's company was working on in surgeries, when they cut the body open, there's a lot of fluids, blood and other fluids. And all of that fluid gets siphoned out into a bag that hangs in the OR. And that bag has a mix of blood and other fluids. If I'm not incorrect, it's the anesthesiologist's job to look at that bag, make a guess as to how much of the fluid in the bag is blood versus other fluid, and then to know whether or not to do a transfusion. Beth's company created a sensor that can go in that bag that can tell you how much blood is in it, so somebody doesn't have to guess.
Right. So Paul got it almost exactly right. Very, very, actually extremely impressive, Paul. So it's not a bag, it's actually a canister, so it doesn't go up high, which is probably a very good thing. The things that go up high are the IV and the blood transfusions, or what you're thinking of, Paul, where you drip into the patient. So you got the visual right. And it uses optical technology. So this particular course and the people and what you guys are working on is really interesting to me because of some of my background in optics. And the initial prototype was actually developed at the U.
Yep. Beth froze.
She froze.
Prototype was developed at the U, and we're going to come back when she unfreezes. We'll go to Kevin real quickly. Oh, back. You froze. We heard that it was developed at the U, and then we lost after that. But we'll come back.
No problem.
Kevin, how about you go next?
Yeah, hi everybody. Kevin Marr. I work as an entrepreneur in residence at the U, working in helping them for the past 3 years look at the portfolio mostly on the industrial side of things. I'm not a life sciences guy, but looking at through the portfolio, see what's there in terms of what could actively be commercialized. And I've been taking a look through and see if there's anything for me. While I'm doing that, I've got a startup that I have actually incubating 3 projects through, and it brings me full circle on my journey in terms of my background. I started as an entrepreneur years ago, sold my businesses and had successful exits, then went to work for corporate America and actually brought the entrepreneurial spirit into 2 corporations to help them solve a lot of problems. And then finally, now I'm back doing the entrepreneurial gig, where my focus is on really developing technologies that are sustainable and applying them and taking them down the commercial roadway. So.
And I want to differentiate. So Lisa and David bookend as executives in residence. Kevin and Beth are in the middle as entrepreneurs. We can go into the difference, but for Beth and Kevin in particular, Beth took one of our existing companies and assumed the CEO role, so it was already a little down the road. Kevin has actually been working with faculty here, and he's been helping them focus their research on opportunities that he sees in the market. So rather than just something being invented in a vacuum, we know that the work Kevin's doing with the faculty has a commercial application in mind, but it could take 2 or 3 years to advance the research to a point where we can put it in a company. So where Beth took over a company, Kevin is actually building the technological base for the company before it's ever started. So, David, how about you?
Yeah, I'm David Noteware. I'm an executive in residence, like Paul just mentioned. I also teach at the business school at the U. The reason I get to do that now is because I founded and took 4 companies to exit in a variety of different industries. My first job out of business school was actually at a photonics-based medical device company, where we raised a ton of money, and it was a long fly ball is the way to think of it. That one didn't exit. But anyway, at this point, I help the companies that are spinning out of the U. I teach at the business school. I also founded and run a private equity fund that's investing in companies that were damaged by COVID.
Excellent. And David has worked with Rajesh and David pioneered the role. He's been with us for about 4 years, and has seen good, the bad, the ugly. And David's primary role has also been to tell me when I'm completely wrong. And I am completely wrong very, very often.
It's a big job.
Yes, it's a full
Big
time.
shoulders there, David.
So one example of when I was completely wrong was when I was working with a startup, and we owed a company $200,000. And the owners of the company were worried that the company we owed the money to would take our $200,000 and then break their agreement with us, and it would be wasted money. I said, they've given assurances they won't do that. We owe them the money. It's our responsibility to pay it. We paid it. The company broke the contract with us. We never heard from them again. And the 2 owners of the company resented me from then on. And this is 20 years ago or 15 years ago. So it was a little bigger than now. Imagine $500,000 screw up like that. Let's start, Beth. Do you have a story like that from your past where you know, in an entrepreneurial role, you had a big screw up? Hopefully not.
Actually, I don't, Paul. I have lessons learned.
How did you avoid them?
Yeah. Well, I give a lot of my credit to my background as a scientist and working a lot with engineers, and the ability to think through the different scenarios and to actually visualize the different pathways where things are going to go. That doesn't mean you always make a good decision. It simply means that you avoid possibly some of the big screw-ups. And also, I believe in asking a variety of people for their opinions. So there are people who know way, way more than I do, way, way more. And so soliciting what their ideas are and their opinions are. So getting the right information in, and then going through a deliberative decision-making process, trying to take the emotion out of it. And that can be incredibly difficult. So one of the lessons that I learned is, actually, this is a lesson that I knew from working in the corporate world, but I brought into startups, and that is always read contracts. Do not sign anything. Read it, understand it, and be responsible for what is in there. And Paul knows some of the stories behind that, but I learned that through watching other people make that mistake, and then as a consultant, fixing that mistake for some companies.
Absolutely. I still, every time I've bought and sold, I think 7 or 8 houses at this point, I still read every line of every mortgage contract.
Yep.
Even though I can't change one of them. I want to know what I've signed up for.
I've changed them before, Paul, in mortgages.
We all have to get Beth on our team.
I should say I'm in awe of Beth and you because I hate reading contracts.
It's awful.
I don't mind it. I know it's a really, most people truly hate it, and I actually don't mind it. So I've been very fortunate that way.
So important. Kevin, how about you? You have a
I-
big blunder?
Sorry, Paul, let me just, before Kevin jumps in, there was a question in chat, which is important. And Jared asked, what does exiting a company mean? So if you, I know David explained it, but I just want to make sure the audience gets it. What does it mean to take a company to exit? Before we move on.
You want me to
Yeah,
answer
okay.
that, Rajesh?
Yeah, go ahead.
Basically, an exit is just kind of the MBA baloney lingo for selling the company. Okay, so you start with an idea, you grow it up, and once it becomes an adult, you have to sell it off into slavery to some big company.
Or you could do an IPO, like.
Right.
I've never done an IPO, but that is an exit. Yeah, I mean, an IPO is really quite uncommon. I mean, the standard exit is you sell to some other bigger company that's in your industry or that wants to be in your industry. And once you sell, then all of your investors can get paid back with their profits, and all the employees who earn shares from sweat labor can get paid out. And the way I usually count success in that kind of situation is I count how many people got their houses paid for. Because like a secretary's house is not the same price as like your senior vice president's house, but it's equally meaningful when their mortgage gets paid off.
That's exactly it. And so there are multiple ways. You can be acquired, you can merge, you can list on the stock exchange. And we all hear about the big stock exchange ones. Even I said about Recursion, but we've had numerous other companies acquired. We had one company that was just acquired. I think it was for $4 million, small. So an IPO is an initial public offering, and it's the first time that your stock shares in your company are listed on a public exchange for people to buy and sell, to trade.
Yeah, great question, Amanda. Yeah, essentially, for instance, let me give you an example. I guess Tesla was a private company for a long time, and it got listed on the NASDAQ, which means that you and I can actually go buy shares in Tesla. Before that happens, only the employees and the founders and the private investors, people like David Noteware and so on, can buy the shares. So it's an option to democratize investment, let's call it.
Exactly. And when companies go public or do an IPO, it's tens of millions or hundreds of millions of shares. So Kevin, big mistake?
Sure, many of them, because I think one of the first important things as an entrepreneur is never be afraid to fail, because failure is part of learning, and you've got to go ahead. And if you're not willing to fail, you won't do anything. So probably my biggest one, and then I always have the same theme. We went into a new territory, brought a really successful technology to it, but we underestimated the amount of money it was going to take to penetrate the market, and we were undercapitalized. And we were successful, but we couldn't scale to the point of maintaining profitability. So that's always the problem. It's usually things take twice as long and twice as much money as you imagine. And being fully capitalized is a really, really important thing.
So Lisa, tell us a little bit. I mean, you've been an entrepreneur and an investor. How long do companies lose money? How long is it before they actually make a profit?
So I think it depends on what sector you're in. For instance, if you are in software development or IT, then it's very likely that a company gets to a point where it's generating revenue and even becomes profitable before it reaches an exit, right? Before it's either goes public or is acquired by another company. However, in the life science space, more often than not, a company never reaches a revenue stage or reaches profitability. In life sciences, you don't generally, when you're making an investment, expect a company to reach profitability. And if it's an exciting enough technology and you have really solid proof of concept and there's good proof that there's an excellent market opportunity, then it's likely that a company can be sold before it has to generate revenue, and certainly before it would have to become a profitable entity.
That's a huge component sort of the commercialization process. And I want to differentiate a little bit right there, because the difference between revenues and profits. Often when we are working on a project, Rajesh will disclose something. He'll have, maybe created a prototype, maybe in the nano fab, he'll be able to arrange particles so that, to create optical properties. But that means he can do it once in a nano fab. He then needs maybe millions and millions of dollars to be able to do it repeatedly or to do it at a certain scale. It may take him 10 years before he could even think about having a product. Rajesh, I don't know if you talk about that in class.
We do talk briefly about it, but yeah, I mean, Paul's certainly right. I mean, as scientists and engineers, we're obviously very interested in making that one thing that works and demonstrate the feasibility. By going from there into manufacturing in hundreds of millions of units or hundreds of billions of units is a huge chasm to cross. I mean, I have an experience of a company, Point Spectrum, which you're familiar with. It was a very promising technology, came out of MIT and Utah, and we took it to a point where I was one of the co-founders. We took it to a point where we demonstrated everything. However, there was no manufacturer that was able to actually manufacture what we demonstrated one off or two off in the lab. So this is a very good, and that essentially resulted in the company being shut down. That's a very good example of that, failure to cross that chasm. So it's very useful for many of you. And we talked about this in the project teams in the class. Really think about how do you scale innovation into the, when we think about selling. Clearly, it depends a little bit on who your customers, whether it's people like us, or is it governments, or is it, is it biotech? So,
So for Rajesh, it wasn't a mistake of science, but it was a limitation that it couldn't be produced at scale to be able to then be sold at a price where somebody would buy it. David, I know we've talked in the past. Some of the mistakes that you've made?
I don't know how much time we've got. There are a lot. But the objective is always to make your assumptions clear like a good engineer would, test them, and then if it's going to fail, kill it fast. So if you're going to fail really fast, whether that's a company or an idea or any sort of business decision, just make sure that it's not such a big failure that it kills your whole company. If I had to point to one biggest mistake in my first company that I founded, which is a finance technology company, we had multiple offers from investors, and they came in at different valuations. The investors valued our company at different levels. And we chose the one that had the highest valuation, thinking we were being smart. In fact, we would have done much better to choose the investors that could have helped us more. So we were a little bit greedy early on, and that ended up biting us in the rear end. So it was an example of our greed overwhelming our good sense. And that was an investment, a mistake that, I don't know, it's been almost 20 years and I still regret it.
So what that means, when David was raising money, he went to an investor and one said, I'll give you 10 million for 5% of your company. And another one said, I'll give you 10 million for 25% of your company, and goes with the one that he has to give up the least amount of the company, but doesn't get any of the help or the benefit. Company goes under or takes longer. And so there's really an opportunity cost to keeping more of the company. Is that sort of what you mean, David?
Yeah, the numbers weren't quite that big, but yeah, the one was a group that had a long track record of being successful and helpful, and one was a newer group. And we didn't think we needed their help because we were just a little bit arrogant, maybe a lot arrogant. And we did need their help. That was another mistake, I guess. We did need their help, and the folks that we chose were not able to provide us help. In fact, they were a big pain in the butt, and ended up sucking the life out of us for several years until we could get them bought out.
So, Lisa, as a venture capitalist, that idea, you know, as a company, we're taking somebody's money. They're investing in us to do something. How does a venture capitalist invest in a company that is new, is uncertain, has a lot of risk, technical risk, management risk, and know that the company's not going to make money for years, if not maybe decades? Why does a venture capitalist give money under those terms?
Lisa, if you don't mind, could you also kind of explain what a venture capitalist actually does, and you know how does the ecosystem work? Because just to give you context, all the students are engineers, and we're not business people, so I think it's useful for them to see that.
Absolutely. Well, I actually started off as an engineer, so I have an engineering background, so I get that. And when I was in engineering, I had no clue that venture capitalists even existed. So quite simply, venture capitalists are individuals who form a fund or an organization, and they then get money from people, and they're called general partners of their fund, and then they go and raise money themselves, and the people who invest in their fund are called limited partners. So the limited partners are the investors, the money behind the fund, and the general partners are the individuals who manage the fund on a day-to-day basis and ultimately make the investment decision. And Paul, sorry, would you repeat your question so that I answer it correctly?
Yeah, so why would a limited partner or a general partner, right? Why would people give their money to companies where there's high risk, limited potential for reward, and maybe like no profits for years, even if there's no sales for years? Why would anybody be so crazy?
Good question. Well, so venture funds that are run well and have been able to stick around, you know, year after year, decade after decade, they have excellent return on invested dollars, and return on invested dollars for a venture capitalist are considered to be greater than 10x invested dollars. So, you know, if you invest 10 million, you're into a deal, you're expecting that you're going to get at least $100 million back from that deal within, most funds have about a 10-year lifespan. So within about a 10-year time frame or sooner, that you'd get that kind of return. Certainly that is not the return that all investors and funds deliver, but that's the expectation. And the good ones do deliver excellent returns. It may not be with every single deal, and it usually isn't, but as long as you can get that kind of return on, you know, maybe 1 out of 5, 1 out of 10 companies that you invest in, then that would be considered a successful venture fund. And it's considered, venture is the riskiest asset class that an investor can invest in, right? You can invest in the public market, you know, investing in stocks, you can invest in bonds, lots of other investments you can make. Venture capital, which is and especially in life sciences or in aerospace or, you know, technology-based companies, those are some of the highest risk investments that anyone can make. So the expectation is high risk but high reward. And as a venture capitalist, it's your job as a general partner to balance that risk reward profile of any investment. So you may look at something and say, well, I'm not sure about the technology, but I know this is a great team, and if this team gets this across the finish line, there should be a huge exit because there's a very big market opportunity for the product. And that's a very simplistic explanation of how you would evaluate or look at an investment opportunity.
And I think most venture capital firms expect that at least 1 out of 5 investments that they make, maybe 1 out of 10, are going to be in companies that go bankrupt or close or never see profits.
I actually expect a higher failure rate than that. It's more like you expect 1 out of 5 or 1 out of 10 to be the home runs.
Oh, that's what I meant. That's what I meant.
And you expect you know,
Yeah.
maybe 2 or 3 out of those at least to just outright fail and you lose all your money. And then the others, the balance to, you know, to give you somewhat of a return, even if it's not that 10x return.
Exactly. So Beth, you just went through a process where for the first time you were a CEO and you went through a process of having to go ask for money. Can you talk about sort of what that experience was like and sort of what you learned from it?
Yeah, actually, I had unmuted myself because I did want to add to this capital raising process. The thing that I learned is, and I would put this under a mistake. We thought when I joined the company, we thought we were ready for venture capital. I learned, so that's what we focused on. That's what I focused on. That's what I did. And I'd raised money internally. I'd raised money for nonprofits. But when you are going to the venture capital world, it is a unique and odd thing to do. The first time you do it, it's just not like anything you've ever done. I've done hundreds of presentations. Every piece, I've done all the different little pieces, but when you wrap it all up together, and then I had COVID on top of it, which added a bunch of nuances because everybody's trying to figure everything out. But I still would have made the mistake. Even without COVID, I probably just would have sunk more time and energy into it. So COVID probably prevented me from making a bigger mistake. Our company was not ready for venture capital. We should have gone immediately when I joined the company. I should have said, we are going to get another grant. We're going to get an NIH grant. And that's what I ended up doing after I learned enough about venture capital, where we were and all of those things. I ended up changing. But all that time that I spent trying to fit us into venture capital. So the mistake is there are many different ways to fund your company. And before you start seeking the funds, you need to understand what all those different ways are that you can raise money. And we'd already had private investments and we'd already had grants. And then deciding what do the different people who are going to be willing to give you company or give you money, what are they looking for? So understand what their perspectives are, not just yours. This is a common mistake that we all make. We only look at the world from what we need rather than what people need from us. And that is a huge, huge mistake. So what do they need from us? What are they looking for from us? And then where do we best fit? And we best fit in the NIH grant area. And that is not where I tried to play originally. Now, we could have gotten venture capital funding, but it would have been too expensive and it would not have been a good choice.
What you said dovetails so well with something David has talked to me about. Kevin, I'm going to ask you about team in a minute, but David, if I remember correctly, one of the first times you tried to raise money was one of the most humbling experiences for you because of what somebody told you, right?
Oh, yeah, you're bringing up a good one. Sure. Just because I made fun of you, you're going to make fun of me. Awesome. So the first time I went to make a presentation to a venture capitalist to raise money, my partner and I had created this fantastic deck with like 15 slides. And I'll be quick with the story. But we went to New York City, went to this huge building where this guy's with Citibank Ventures actually, went to the 70th floor. He let us cool our heels for 30 minutes out while I was waiting to get to see him. Then we go in and we start talking with this guy, Ira Rimmerman. I'll never forget that, Ira Rimmerman. So Ira takes our deck and we start talking and we're like, yeah, I'm David and this is Bhairav and we want to talk to you about this opportunity. And he'd already taken our slide deck and was at slide 3 by the time we even introduced ourselves. And then we said, this is what we want to do. And we're on slide 1 and he's at slide 5. We get to slide 2, he's at slide 7. We get to slide 3, he's finished with the whole darn presentation and slides it back across the table to us and says, yeah, this isn't fundable at all. And we're like, we just came all the way to New York City. We waited 30 minutes and you're darn out there. You took 4 minutes to evaluate our deck. And we spent 6 weeks, 7 weeks creating this damn deck. And he's like, yeah, you're focused on all sorts of stuff that doesn't make any money. The only part that makes money is this one part, and all the rest of it is just garbage. And we're like, but you don't understand how much we worked on this. And it took us 8 minutes, and we were back at the elevators out the door. And we got down to the bottom of the elevators, and we're looking at each other, and we're like, holy crap, what just happened to us? And it took us 3 weeks to figure out that Ira was dead on correct, and that all the stuff that he said was meaningless, was just fluff, and we should get rid of it. We took all of his advice. He ended up investing in the company. And it took us a number of years to build it out, but that's the first company we ever sold. But the point of the matter is that we were so wrong, and it took us 3 weeks to figure out how right he was and how wrong we were. I'd like to think that we would not make as many mistakes now, and I'd like to think that I would listen more clearly when somebody tells me I'm wrong. My wife might argue against that, but the upshot of it is that those folks see a lot of deals. And a lot of things that we thought were novel were not. And a lot of things that we thought were just brilliant were not. And he helped focus us on the part that actually could create revenues. We ended up building that company up, became a great company, and then sold it, but only with Ira's help. And Ira made a lot of money on that, for the record. He did great.
Yeah. And so that's, I think it's true in companies, it's true in patents, right? If we're researching over this, it's our baby. It's something that's so important to us. If only everybody understood. The problem is they probably understand better than we do, and they understand the context. And so we can't get IP, we can't get investment, we can't, right? To Beth's point, we have to take ourselves outside of ourselves and then give ourselves that critical evaluation. And it dovetails so well. Kevin, one of the things we always hear, you bet on the jockey, not the horse. You want to talk about what that means and sort of what made David such a good team, so coachable, so right, like wasn't afraid to come back and had to take another bite of the apple. All that. Just talk about teams a little bit.
Yeah, sure. Having the idea and making something happen, it takes a team to do it. And you can have an idea that's okay with a great team, and they will make that successful. You can have a great idea with a poorly functioning team, and it will die. So a lot of investors will look at companies and they're really investing in the jockey, i.e. the team that they know is going to be able to overcome the hurdles, because there are hurdles that are going to come up all the time, and having the ability to pivot and say, hey, we've got an idea where we're going one time, but market conditions change and maybe the product market fit changes, which is ideally making sure that your product is designed for the market that you're trying to go to. Those two things have to fit together. A lot of change happens a lot of time. And if you don't have a team that's really capable of being able to pivot and actually succeed, it's going to wither. So a lot of venture capitalists will look at it and really evaluate whether they've got the team that they think can get the job done. So teams extremely important. Surround yourself with the best and the brightest people who are committed to the vision of where you're going. You can have a really high performing team or high profile team that doesn't perform well, or you can have a team that actually is integrated really well, understands where they're going, and they're willing to work together to get over all the hurdles.
So,
can I just add quickly to emphasize that point? As an investor, every single time, hands down, if I'm presented with a situation where I've got a stellar team and maybe not the most awesome technology, but a really stellar team, and I've got another opportunity that is similar, but has a very inexperienced or not a stellar team. And even if they have the best tech on the planet, I will always go with the investment with the best team around it, because the best team has been there, done that. They know what mistakes have been made and how not to make them. And they will make a success of a lesser technology, whereas an inexperienced team or a team that's too arrogant, doesn't know what the hell they're doing, they can take the most awesome technology and crash it into the ground along with tens of millions of dollars.
So can I add something into that?
Yeah.
One of the things that Paul frequently asks me to go do is to interview the entrepreneurs at the U. Frequently they're professors, or the candidates to become the CEOs of spinouts and that kind of thing, and to figure out who I think is fundable and can be successful. It rarely has to do much with their technical expertise. It has a lot more to do with how well they can work with others and whether they're coachable. Coachable is one of those kind of other buzzwords, but coachable people are able to take feedback and not freak out and figure out what is what's useful and what's not, and then parse it and then apply it in a good way. Some people who are super smart just can't do that. Likewise, some people who are super smart can't understand the processes that need to be followed to go raise money and to build a team, right? They're better at writing their own papers and doing their own research than they are at aggregating groups of people to work as a unified unit. And those are different skills. And I mean, half the time Paul sends me in to go talk with professors to tell them that they should just stay professors, okay? And do what they do really well. And then hire people who have candidly lower level skills, but can build companies. Because it's not as hard to build a company as it is to build the invention that's the foundation of a company. But the professors frequently think they can do everything and do both. And they'll send in like a Lisa or a Beth or a Kevin or me to go, okay, we're kind of peers, and say, okay, Professor Bill or Professor Molly, stay a stinking professor, you're good at it, and let somebody else run the company. Which is not always what they want to hear. But
and occasionally there's somebody who does want to go from science to be an entrepreneur. And then we say, look, if you have the aptitude, it's a full-time job. But if you're willing to give up being a professor full-time, we'll work with you, we'll help you. But we'll help you as an entrepreneur to build a company.
My favorite entrepreneur in that regard was a guy who was a professor at Johns Hopkins who took some technology out that enables him to turn on and off genes, okay? And was fantastic for building for molecules to address health issues. But in order to take that job, he had to quit his position at Johns Hopkins because running a company like that is really hard, really, really hard. And those professors are super smart, but they're not trained in that space. They learn really fast. They learn really, really fast, but they don't have the experience. And you can't be a full-time professor and a full-time CEO at a company like that at the same time without it being highly correlated with failure. Okay, so.
Yeah, David,
I'll make a, sorry, Beth, I'll